It is my great pleasure to be here this morning and introduce and kick off a panel that I think is going to try and get to the nub of this kind of comment and issue which has come up repeatedly, the intersection of new technology with old law, dealing with fundamentally sensitive and volatile issues regarding what is or is not equitable and where we draw the line in society. My name's Aaron Klein. I'm a fellow in economic studies at the Brookings Institution, a co-organizer of the event, and I'm here with a fantastic, distinguished panel, which has a wide variety of expertise and perspectives. And rather than go through their illustrious backgrounds, all of which are available for your information, or hear their fantastic latest adventures in their different endeavors, I want to engage in a interactive conversation, because I think it's only through kind of a Socratic-like dialogue of challenging each other that we can find the full tensions that are underlying the core issues here. And so I want to start with, one of the many 800-pound gorillas in the room, which has to do with chartering. It's always struck me very intriguing that businesses are mostly licensed by the state, which is a pretty easy thing that's fundamentally a permission. You can do this. You have a license to drive. You have a license to serve food. You have a license to sell alcohol. And if you kind of screw up, the state reserves the right to take this privilege away from you. But licenses are relatively easily granted, and usually have a term. A license expires. A charter is a grant from the crown. It goes much further back in human history. That's fundamentally a obligation in perpetuity granted to the state. Beyond banks and the original 13 colonies, I struggle to find other things that are chartered. Colleges, right? These are things meant to exist in perpetuity, which is kind of interesting for a business. So we have this idea that fintechs are somewhere caught in the middle. Are they licensed? Are they chartered? Bank regulators are starting to open up about chartering. The OCC's proposed something which we all call the FinTech Charter. The OCC points out they only charter banks. But the FDIC is talking about restarting the provision of the Industrial Loan Charter, ILC. There are a lot of areas to address, but let's start with the debate on the pros and cons of the OCC proposal, talk about the FDIC's potential ILC approach, and of course there are always the states. Todd, what do you see as the pros and cons of each?
So as with so much in the financial services industry, it requires a little history to try to figure out what's going on here. I'll start with the Industrial Loan Company Charter. So the Industrial Loan Company Charter history is industrial loan companies were essentially consumer banks for urban working people back in the 20s. They were hung around and had limited deposit powers, but existed in a number of states. And they really came into prominence only when it was understood and realized that one could engage in banking through an industrial loan company. The provisions of the law were liberalized to allow greater powers to those companies, and be a commercial company. So you could avoid the Bank Holding Company Act limitations, which generally said that anyone who owned a bank was limited in their activities to financial activities and banking activities. And so industrial loan companies were used by companies like GE and a few others to acquire banking arms to do essentially consumer banking. They became a political football in a big way when Walmart, the major retailer at the time, looked into the possibility and actually applied for an industrial loan company charter to start its own banking operation. That caused an enormous backlash in Congress because the small banks particularly were very threatened by the idea that Walmart would enter the banking business. And as a result of that, essentially there was a moratorium on industrial loan company charters, and the FDIC effectively stopped processing industrial loan company charters. That is now about to change, as Chairman McWilliams, I think, actually referred to yesterday. They are going to start looking at industrial loan company charters again. Now, so why is that significant? Well, an industrial loan company gives you all the advantages of a bank. You have deposit powers, you have access to the payment system, you have the ability to export your state law on interest rates. In other words, to operate a national business from a liberal state, Utah being the state of favorite chartering for industrial loan companies. And most importantly, you get to avoid the Bank Holding Company Act. So why is that important for fintechs? Obviously, they're owned by venture capitalists if they're not public, and those venture capitalists would like to avoid becoming registered as bank holding companies because they couldn't do their main business if they were. What are the disadvantages? It's really only the disadvantages of being a bank, which is that you have capital and liquidity requirements, you're subject to things like the Community Reinvestment Act, and you overall have to comply with a lot of regulation and oversight. There is one big problem, though, which is, I think really, without intending it, the Volcker Rule applies to people who have controlling interests or companies that have controlling interest in industrial loan companies. And what that means for fintech is that if you're a VC-backed fintech, you basically can't, your company that you invest in can't get one of these industrial bank charters, industrial loan company charters, without causing you to be subject to the Volcker Rule, which basically prohibits investment in private investments as a principle. So a venture capital firm is in the business of private investing, can't do that if it also controls an industrial loan company. So that is the deal killer for the industrial loan company charter for small fintechs at the present time. A large fintech or a public fintech like Square could own an industrial bank without Bank Holding Company Act problems in all likelihood because it doesn't have a large controlling shareholder. So in recent history, a number of fintechs have applied for industrial loan company charters, one of which was Square, another which was SoFi. They withdrew those applications because the FDIC was simply not processing them. Now the door is open again, and some of them may refile. SoFi, it would appear to me, has a Volcker Rule problem, a pretty severe one. Square may not. So it's possible that we'll see somebody getting an industrial loan company charter. Now, here's the other issue. If that happens, the whole Walmart controversy may revive again. And in that case, certainly you'd see congressional action trying to, in some way, control the loophole. Why is that? They're concerned about Walmart, but now today they're really concerned about Amazon. The small banks do not want these large companies to get banking powers in a way that would disadvantage the existing community banking ecosystem. So it's likely that if Square were to get an industrial loan company charter, it's quite possible that we would see legislative action to close the loophole from the Bank Holding Company Act and really start the whole fight again about banking and commerce, which has been a longstanding dispute within the country that was partially resolved through the adoption of the financial holding company rules. Now, I've confused everyone, I'm sure, with all this lingo. The way to think about it is, right now, a large fintech could get banking powers if the FDIC would grant it, and if Congress doesn't reverse that. A small fintech, right now, without changes in the Volcker Rule, can't really get an industrial bank charter. What does that mean for the FDIC? I don't know how they're going to actually approve one of these applications. because they know what's coming from the political side. They could impose all kinds of conditions on the approval to limit, the activities of owners of the company, but that in many ways might, make the charter less attractive. So it's not clear to me how the FDIC is going to both process these applications and not run right into the buzzsaw of legislation to overturn what they do. Okay, so let's turn to the other alternative that's been getting a lot of interest, which is the OCC FinTech Charter. A lot of publicity. The OCC FinTech Charter is the OCC's effort really to get around the fact that the FDIC has just not been chartering non-standard banks of any kind, right? So even if you wanted a full bank charter and you came in as a fintech and you had an unusual business model, the FDIC basically wanted nothing to do with it. It was chartering banks that looked like the First National Bank of, Middletown, USA. Those were what it was willing to charter. It wasn't looking at anything that was unusual. So the OCC was trying to do something to spur activity. And so it came up with the idea of chartering a national bank that didn't have deposit powers. Now, why is that important? Because the FDIC only gets involved in the process if the national bank takes deposits. So they took a rather creative interpretation of the National Bank Act to say that, well, we can still charter a bank if it doesn't have deposits. We adopted some regulations 15 years ago that say we can do that, and so we're going to go ahead and propose to do that. Now, what are the advantages of that? Well, you get all the preemption powers that a national bank has, which is very important for lenders, so fintech lenders like that. You avoid bank holding company status because the bank holding company limitations on ownership and activities are tied to the existence of insured deposits. You probably avoid the Volcker Rule as well. And that means that, theoretically, even a venture capital-backed fintech could get in one of these OCC FinTech charters and have significant powers. Well, what are the disadvantages? Because there are many. The first one is you don't have automatic access to the payment system. The Federal Reserve takes the view that that doesn't come automatically with a bank charter, and it would have to approve individually access to the payment system for any of these fintech banks. And they've made a lot of noise about it, the fact that this is going to essentially raise some pretty severe policy issues, and they're not sure how it will come out. For most fintechs, what's the most important thing? It's really access to the payment system, direct access to the payment system. Today, there's an enormous toll paid by all fintechs because they have to go through banks to access the payment system. So without that power, the value of this FinTech charter would be limited.
We gotta. Is this almost the?
Yes. Sorry. There's another serious problem with the FinTech charter, which is there's a legal challenge to it, right? Which is, does the OCC actually have this authority? No one really knows. The prevailing view is that it does. But I think there's a very strong contrary view. The problem now is that no one is going to apply for an OCC FinTech charter if they don't know whether it will be ultimately upheld, and that could take 3 to 5 years to find out. Fintechs don't have 3 to 5 years to wait around to see whether they're going to get this authority. So it's essentially a catch-22. No one's going to apply for a charter unless they know that it would actually be upheld. And by the way, we'll never find out whether it's going to be upheld until somebody actually applies for and gets granted a charter. So it's a significant issue.
So now that we've got a Kafka-esque circle, Frank, how are the fintechs gonna get through this?
So I think, as you could have heard from actually a terrific distillation by Todd of an incredibly complex system, that it's really going to be a difficult choice for fintech companies to decide at the corporate level what kind of charter they should have. But maybe starting with options and just think about it for a minute. The options really are, one, the bank partner model, which continues to be a very effective and we think potent model for the system and for the companies. So to work with an existing bank, you could, as Todd points out, take the gamble and apply for a FinTech charter with the OCC, and that has some real successful elements to it. You could do the ILC, or you could really go the state license route. And I think one thing that's exciting about the current environment is that these are in flux. The different regulatory bodies are looking at each of these options. The Conference of State Bank Supervisors is identifying ways in which the state licensing system could be improved. So I think probably what, and maybe this comes back to Todd's point, is that I think some folks are going to continue to wait as this process evolves. The rights and options, I mean, for many fintechs, especially those who are in the lending side, the most important things are, the ability to access a national platform and the ability to access low cost of capital. And the different charter options offer different strengths and weaknesses in each of those regards. So I think for many it's going to be a wait and see. The complexity of the corporate banking regulation, as it were, should scare any small company. It's really not something to be taken on lightly and creates a powerful barrier to entry for in favor of large banking institutions. So, on the other hand, all the consumer protection regulations apply. So no matter which of those models you use, consumer protection and basic banking rules, apply to all fintechs. So I don't know if others have thoughts, but our perspective would be that as the powers continue to evolve and the responsibilities in the different charters, I think we'll see which one wins out. But right now, I think the bank partner model still is really the best option for most fintechs.
Yeah, I would tend to agree with Frank that each of the platforms are assessing the various options. The industry itself has evolved since the time of the issuance of the OCC FinTech Charter proposal. You see banks now like Goldman Sachs entering this market and using deposits to fund those loans. So I think in addition to the ILCs and the FinTech non-depository, I think platforms will be considering all options. How important is a stable funding, a deposit-taking role for their model? In our comment letter, LendingClub's comment letter to the OCC's FinTech Charter proposal, we highlighted that it was our encouragement that the OCC set the bar high enough that this charter could not be misused by any predatory or high-priced lenders. We encouraged them to adopt a financial inclusion strategic plan that would be required by all applicants, including the establishment of measurable goals after receipt of community input. A form of that requirement was included in the final proposal. We also encouraged the OCC to consider the products and terms themselves that will be offered by these applicants to assure that the bar is set high enough that there is not a potential for harm how these new institutions will be used.
I'd only add that I think the old school traditional path might become more viable for companies over time. I think Todd noted that the FDIC has not exactly been eager to grant deposit insurance to novel business models over recent years, but I think that's likely to change, and partly for the reasons that Todd pointed out on the ILC charter in terms of the sort of political dynamics around that. Those are not present in the case of a traditional national charter. So if you get a national charter and apply to the FDIC for deposit insurance, I think that door might be more open going forward than it has been in the recent past. And you don't have to. It doesn't raise the ire of the ICBA and the community banking community quite as much if you are perceived as going through the front door with a traditional charter. But it's a really high bar, and you saw Vero recently got conditionally approved by the OCC for a national FinTech charter. They're a digital-only bank, and relatively traditional business model in certain respects, but digital and online only, approved by the OCC. And the OCC, as one of the conditions to final approval, said you have to raise $104 million of capital on day one. So it's not a cheap entry ticket, but it's an entry ticket nonetheless. However, massive asterisks to my prior comments, they withdrew their application to the FDIC for deposit insurance. So where exactly we're headed on that remains unclear. But I tend to think that traditional national charter route might become more viable than some of these alternatives over time, as it's perceived as less controversial. And it's easy to forget that not too long ago we were approving something like 200 new banks a year and had about 100 banks failing a year. So we saw on net, bank growth for a while, and then even in the period of consolidation, you saw upwards of 100 banks being approved in per year. So these are really anomalous times from a de novo banking perspective.
Yeah, I think that's really interesting history, Jonah. And just from my perspective, to go into some FinTech history, I've been at OnDeck since 2011 and coming to these panels. And for much of these panels, the cry was, this is FinTech as regulatory arbitrage. You ought to regulate these FinTechs who are in the business of providing financing like banks. Now that the regulators seem receptive to perhaps doing that, the cry is, oh no, you can't give a FinTech a banking license and regulate them as such. So it is, from where I sit, somewhat confounding, but as all the panelists have pointed out, we are continuing to evaluate the pros and cons of each of these.
I mean, one thing I might add is that to what Jonah and Cory just said is, the regulators have all the power they need to charter, provide special capital and liquidity requirements, put any conditions they want on FinTech banks. They should be chartering FinTech banks, right? And treating them as the individual businesses they are and putting in appropriate risk controls on those individual businesses. They've chosen not to, and that is what's preventing this, this basic good idea, which is to bring as much of as possible of innovation into the banking system in an intelligent way.
So let's build on that and pivot into the questions regarding fair lending, because there's a lot of debate regarding the incorporation of alternative data and new credit underwriting. We had multiple panels on those earlier, and on the one hand, there's this great potential benefit for the underserved, and simultaneously, how do you treat protected classes at a disadvantage? There's also the concern that credit decisioning technologies may discriminate without people intending or realizing it. Fed Governor Brainard's point about the AI that kicked out anybody from a woman's college, I thought was fantastic. There's also tremendous legal variation regarding what constitutes a protected class. I assume anybody in this room that wanted to provide credit and offer different rates to men and women on the basis solely of gender wouldn't get very far. But if you want to provide car insurance and discriminate solely on the basis of gender, that's not just legal, that's standard industry practice. Both are financial services. Gender is the same protected class. So we have very differing legal constructs as to how we relate to this. Jonah, how do you think of these issues from a policy position, and how do you think about them from a business position and see the businesses in your incubator thinking about them?
Yeah, so I mean, I think the policy debate has sort of been well framed in the last day and a half, in particular in Governor Brainard's comments. I think on the one hand, huge upside and potential from the perspective of having the possibility to serve a really large segment of the community that is currently underserved. I mean, I think the statistics we saw yesterday, there was some variation in them, but they were quite stark, right? I mean, no matter whose data you looked at, a majority of the country is non-prime under traditional credit metrics. That means a majority of the country is not being well served with what I think we've all defined over the last 2 days as traditional or non-alternative data. So, huge opportunity from a policy perspective, and I think that's why so much of the conversation around fintech for the last several years has been, sort of focused on financial inclusion and broader access. And I think, we're starting to ask the really hard policy questions about, is fintech delivering on that? And I think that's where, regulators and policymakers are starting to really want to know what's happening. They want to go under the hood a little bit and understand, exactly who's getting served and how. And I think, some of these questions will get harder as we move through a credit cycle, and some loans start to go bad, and everything will look sort of worse in the rearview mirror. But I think that's the big sort of upside. And then the policy risks have also been, I think, mostly well articulated. Issues around fair lending, questions about, especially in the sort of more esoteric data, what kinds of correlations are there really with, things like protected classes that we need to be worried about, and are companies who are leveraging interesting new data sets thinking appropriately about that on the front end. I think, one other policy issue that I'd highlight that hasn't gotten a tremendous amount of attention is sort of how the data flows in these sort of non-bureau data lending cases. So whether it's bank account data, which we've heard a lot about, or more alternative types of data. And there have been, serious policy discussions in the US over the last 2 years around consumer data access, in particular, how financial account data is appropriately shared sort of safely and securely. And we can get into that a little bit later, possibly. But, I think there's at least an effort to build an appropriate framework around the flow of financial account data. Some of the more esoteric data, I think we have to decide whether that's, is that subject to our traditional FCRA framework or something else. So I think those are at some level the policy issues. I think from a business perspective, on the one hand, they see the same opportunity, right? They see more than half of the market that is not well served. So I think that's where you've seen particular fintech lenders try to play, and they've tried to bring, to an increasing degree, alternative data sources to bear to sort of fill out the credit profile of potential borrowers and be able to serve them in ways that they haven't been able to serve them with traditional credit scores. And I think another way to think about the opportunity, certainly in the consumer loan space, is technology enables personalization at scale. So rather than looking at broad, relatively crude sort of categories of credit scores or credit buckets, you can really get into a person's financial profile. And if you can do that in an automated and digital way, you can do it at scale. So I think that's another opportunity. And there's some really low-hanging fruit again that we saw yesterday. So I think the gentleman who was representing a data aggregation provider in the utility space noted that just by adding utility payment data, you could get 60% of borrowers could get uplift on their credit score. That's from a single data point. That's pretty powerful. And if you look at the Ultra FICO score, they're incorporating just a handful of cash flow components, and they're seeing something like 70% of thin file customers get credit score uplift. So that's relatively low-hanging fruit, and I think, but nonetheless, a big opportunity. I think the one sort of underappreciated opportunity, at least from my perspective, is the opportunity to have real innovation in terms of product design and product structure. And it's, we talk a lot about underwriting algorithms and credit decisioning, but I think the ability to manage the life cycle of a loan and to better service a loan over time, on the basis of whether it's financial account data or other data is sort of underappreciated and maybe something that'll become more into focus in coming years. But I think, technology allows us to do more than sort of make a loan and hope that we get repaid. And you're seeing some early efforts from companies like LendUp, and I know Marcus, for example, has they essentially allow the borrower to pick their own repayment date based on when they're likely to have, money in the bank to make that payment, and they don't impose, you get sort of a grace period in repaying. And I think those sort of flexible repayment terms could have a big impact on how people behave from a credit perspective. And so I don't know, that's sort of two sides of that coin.
Jonah, I'm sorry, I don't mean to interrupt, but on that one point, I think it's worth noting that what that does is that creates a pool of loans that are very different.
Yep.
And so if you're mostly engaging with investors, whether in the capital markets or otherwise, that non-homogeneous pool becomes more challenging. If you're a balance sheet lender, so again, coming back to being a bank, if you're a balance sheet lender, then then that's a great, that's a great option.
Thanks. You made my final point in my notes. So.
I'm sorry.
Perfect.
Richard, do you
Yeah, so we're often asked in these type of policy settings, how can you ensure, that innovations in alternative data, AI, and machine learning that are used in the credit underwriting process will not result in discrimination? The concern, as highlighted by Governor Brainerd yesterday, is that technology may discriminate without companies even realizing that they are discriminating and certainly not intending to. Marketplace lenders have made great strides in providing lower cost and responsible products to borrowers who have been overlooked or overpriced by traditional lenders using traditional FICO-based models. This fact has been confirmed by researchers from the Philadelphia and Chicago Reserve Banks that Jalapa knows well and has shared with this audience in the past, using LendingClub data as a proxy for the industry. But to continue to invest in these powerful data analytics and systems, we need to have regulatory stability as well as a pro-innovation regulatory environment. Now, we believe that the disparate impact regime provides that regulatory stability and is pro-innovation and has not been onerous to comply with in our experience. The disparate impact regime is outcomes-based, it's not rules-based. So it is not prescriptive on what types of data or inputs can be used in our models. It does not require that we use a weaker model. What it does require, and what may often not be fully understood by all, is that if a model does produce a disparate outcome, that you have to find the least discriminatory model that is similarly effective, i.e. that it meets a legitimate business need. Now, we shared these views in writing with the CFPB in a response to their RFI on inherited regulations, and our letter is publicly available, and I'm happy to share it with any who are here today. And while we encourage others in the industry to consider a similar position, we're also encouraging regulators to think about how they can take additional steps in continuing to promote this innovation in the use of data and investment in systems by taking a few additional steps. So, for example, maybe adding additional clarification to what constitutes a legitimate business need by updating the last interagency guidance policy statement in this area that was from 1994, and also considering updating the FFIEC's interagency exam procedures on fair lending.
Maybe just to add on really briefly to what Richard's saying, from a policy perspective, I think we actually talked about things that are more far-reaching in prior panels yesterday, some of which would be very interesting, whether or not they include sandboxes for certain types of alternative data or certain types of disclosures. But there are also things closer to home, as Richard points out, that could also help from a regulatory process perspective, and one would be continued improvement in the credit bureau system itself. It's actually fairly clear that not all folks who are furnishing information furnish in complete data sets. You wouldn't necessarily need bank statements if you had full payment information in the bureau system. So, and the quality of the data can be variable. So could machine learning or artificial intelligence be used to help improve the credit bureau system? So there are actually a lot of things that regulators can do right now today with existing powers to, I think, improve the potential for credit invisibles to get better treatment.
And to bring it back to what we talked about yesterday, Richard's proposal, which I think has got a lot of support generally, does require that AI be interpretable, because it brings back to this whole question about whether AI models and machine learning, we will be able to understand why they make the decisions they make, because interpretability is really critical here.
So I also think there's a tension between, Jonah, what you were talking about variable repayment what Usman's with PayPal went through yesterday with variable repayment, and what the prior panel said about the small business TILA Bill of Rights to allow people to know their APR. Well, APR is based on knowing what the term of the loan is. It's actually mathematically uncalculable if you have no fixed term of a loan. So how do you guys square the disclosure requirements in the existing regime with the technological change of the new regime?
I mean, there's no reason that if I'm toggling through some options as a consumer, I can't be presented with, okay, if you pick this repayment date, here's what that means for your interest rate. You know, I also think it points out why APR is just a pretty dumb metric, but we've come to rely on it an awful lot. So,
Or just even an open-ended, you know, your APR will be, assuming this payback, your APR will be in this range.
Yeah.
I think it's a little bit disingenuous to say, oh, it can't be done. It's not terribly complicated to give someone at least a range of what their APR would be, assuming a payback date.
yeah, 1 month out, 3 months out, 6 months
Exactly.
out. Here's your.
And it points out again that you know, the system we created for a particular type of products and sets and world just isn't working for anything that involves change in the way we do our basic business. And all these are positives for consumers, and they create difficulties with a fixed approach to disclosure and to consumer protection.
So I have time for one more question before turning to the audience. And I think privacy is the last of the gorillas that haven't come up to be raised. You know, as an economist, I see a big disconnect between stated and revealed preference. When you ask people, people say that they really value their privacy. And when you say, give me your most secret real-time information about where you are in the world, in exchange, I'll tell you if your road home is yellow, green, or red, people give that privacy up at a heartbeat for nothing, right? Google Maps. So, you know, Europe's moved to GDPR. California legislation is moving to what some have called GDPR light. Some tech companies have talked about a more comprehensive federal approach. Cory, you're in this space. What do fintech companies do in the current environment, and what are the right policy principles to guide us?
Sure. So I know we're pressing up against the clock, so I'll try to be brief. But like anything else, I think we need a balanced approach. On one hand, greater data and information has led to more choice, more options, more customization, not just in financial services, but with other goods and services as well. That obviously needs to be weighed against privacy concerns, and I think the U.S. Chamber has taken a good first step in laying down some broad principles that would make sense for financial services companies and others to follow that could be applied, and our hope would be on a national basis. Aaron mentioned that California has enacted its own privacy laws, and if that trend persists throughout, the other states, you could have a scenario where you have different laws in each state. The laws could conflict with each other, and you're left with the patchwork that I think we would be better served. We, as just a broader economy, would be well served to avoid. So I'd advocate for a thoughtful national standard when it comes to privacy.
Anybody else want to?
Yeah,
Go ahead.
Todd.
I was just going to say that Senator Wyden actually proposed a version of GDPR for the U.S. It's got some draconian aspects to it, but I think all of us wish that a conversation would begin on what the appropriate national standard would be.
Yeah, I mean, if you think about, we have multiple standards in the U.S. today that apply depending on where the data comes from, what is being used for, et cetera. So the sort of quick tour of the status quo is our traditional bucket, bureau data under an FCRA framework, essentially a framework built to solve consumer problems in a world where a bunch of your data is being collected about you without you having permissioned it, or in most cases even knowing about it, and then being used to make really important decisions like, can you get a loan, can you get a job, can you get insurance? So we build in back-end protections. You have the right to know when that data was used to make a negative decision about you, and the right to make sure that that data was accurate. And most of the alternative data we've been talking about for the last 2 days, has been said numerous times, involves bank data. there are ongoing discussions about the appropriate framework for that. Europe has a framework now for PSD2. There are privacy elements to that, but because it's permissioned on the front end, the privacy issues I think are less prevalent, and it's more about how to do it securely. It's more a sort of data security framework, and making sure that everybody who touches that data is up to appropriate standards. And then, there's sort of the Wild West of other crazy data points that people have been talking about, and I think we have to figure out the right framework for that. But, I'd only finish by saying our data privacy conversation in the U.S. is much, much bigger than financial services, and I think would be well served with, hopefully a national standard, but if California can get the ball rolling, at least some standards on the data privacy front, because it's becoming, sort of an endemic problem, and people are going to lose trust if they start to feel like their data is being misused.
So I agree with everything you guys are saying, and a national standard, I believe, is critical. That said, it feels as though we're going to get a very large number of large entities in the U.S. that will push for GDPR because they're already complying with it.
Fine with me.
Okay. So, Melissa?
Just on this, can you elaborate what it would mean for the financial sector if we had GDPR as the national standard? Or should we be thinking about an update to FICRA in the data context so that we are allowing other data but controlling for accuracy, privacy, transparency?
Well, I'll jump in just to say that GDPR has the advantage of being a complete standard, having something for everyone in the sense of a right to be forgotten, the ability to turn on and turn off your data feeds. It may not be realistic in Aaron's world because, how many of you have recently clicked the little thing that says we're collecting cookies, which is probably a GDPR? Everybody does it. Nobody actually controls their own privacy. But
I mean, the biggest difference is, so if you look at California's sort of GDPR light, it's, it does not go nearly as far as GDPR in a number of areas, but the key aspects of it are you have the right to know which data about you is being collected, sort of at the category level, and you have the right to basically tell people to stop collecting that data if you want them to. And those are sort of the key aspects. I don't think it goes as far as the sort of full right to be forgotten. You have to erase all of your data, et cetera, which can be incredibly onerous, in particular if you haven't built your data architecture to support that function. But I think, I think the GDPR is actually not, it's the sort of California version of GDPR is not, it's not that much of a stretch from the existing FICRA landscape. I mean, like I said, FICRA is a non-permission system, so I think I think it would build in more transparency for consumers, up front. I don't think the California bill even applies to bureaus because they're covered by the existing FICRA framework. But I don't see any reason why the two can't work together. I think the key things are in the Treasury report, the bureau principles, all the sort of policymakers who have opined on this. The key things are consumers should know, which data about me is being collected, what's it being used for, and I should have the right to tell people to stop doing it if I want them to stop.
and maybe minimization, which is using it for as little and as short a period as you really need.
Agree. That disclosure about what it's being used for is the premise on which you base the data minimization. I think that's incredibly important.
Frank, do you have anything to add?
So nothing is detailed. I think it's going to, no matter what we do, it's going to significantly impact businesses. But we don't have a European operation. I think the significance, though, of retrofitting your technology systems, it's actually going to be easier for a company like ours. But the internet is a giant copy machine, and so this idea of root and branch understanding exactly where this data has flowed in all of these systems. We think, oh, Facebook is just the truth of it is, whether it's AWS or all these other things, your information is probably everywhere. And so to now put an obligation on the companies to put fences around that and forget it, I'm actually in favor of, but it's going to be a mammoth challenge.
All right, we have time for one more question. The last time we tried privacy under Graham Leach Bliley, we ended up with a win for lawyers and the post office. and a loss for every person on earth who never read their 72 pages that they got in the mail over and over and over and over and over and over again. Who's got the
More
final?
Schumer boxes, Aaron, more Schumer boxes.
Got the final question over here.
Yeah, hello. Ila Filat from Shanghai University. I would like to ask, with the recent midterm elections, what are your thoughts on, if you like, the future changes to the legal environment, specifically the bill relating to Madden and Midland?
Madden Midland in either the lame duck or the new split Congress. Takers.
Look, I'm an optimist, but balanced by being a realist. It may be challenging to get it through Congress, but I think that that there could be a regulatory fix that we may want to think about if Congress is not a viable alternative here.
I would just say I have a ton of confidence in Nat Hoops and the MLA, and believe that something can get done legislatively. But definitely concur with Cory that the regulators have plenty of authority to take action and to, I think, clear up the issue.
Yeah, what I'd add is I think FinTech really presents a real opportunity for bipartisanship. There are not many opportunities in Washington. I think FinTech is one, principally because I think from the Republican side, we're introducing new competition for large financial institutions, and on the D side, we have the opportunity to provide enhanced consumer benefits and financial inclusion. So I do remain optimistic that there is a way, particularly where you have a House on the Democratic side, to try to find a bipartisan solution here.
I guess I'm forced to add that from my perspective, Madden is actually the issue that has started to turn FinTech into a partisan issue, and for better or worse, it's become a bit of a scrum. And so, on this particular issue, I'm a little bit pessimistic. I'm not sure. I do think that Waters is going to try and find areas to get bipartisan things done. If she's going to have a lot of members within her own, her own caucus on her own committee who want to get things done, including possibly the Madden bill. So you can't rule it out, but it's become a really tough issue. And to see something like that happen in the lame duck session, I think would cause a tremendous amount of blowback. So yeah, I'd be working with the regulators.
So I'd note that I'm a little bit heartened by the what looks like the outcome that Congressman McHenry is going to be the ranking Republican. There was unclear with Chairman Hensling's retirement who would get that gig. McHenry's devoted a lot of resources intellectually to understanding FinTech, and I think that's at least the best first step one can hope is members who understand the substance and reality behind the situation. Because in order to become chair ranking of a committee, you often have to spend a long time in Congress. The longer one spends in Congress, perhaps the further one comes from understanding the dynamic changes in the current marketplace in FinTech. With that, join me in thanking the panelists and preserving most of your coffee break.